Floating rate notes are bond instruments that have their coupons linked to a reference rate. Typically that's 3-month LIBOR. And what that means is that when interest rates rise, the coupons of these floating rate notes also rise, and therefore they provide you with a hedge against rising rates. Because of the coupon adjustments, it means the prices of these bonds stay stable, and typically we find that these assets are a lower volatility part of the bond market than traditional fixed investments. Well, the hedge against rising rates means that we have a performance advantage if we see rate rises and we're invested in floating rate notes. But also, considering the flexibilities in our fund, we're unconstrained, investing across the capital spectrum, both investment grade and high yield. We're also multi-sector, accessing corporate risk and securitized mortgage-backed investments. It means that we can find yield-enhancing opportunities and make sure that we have a high running yield in the fund, even if interest rates don't rise. So we have attractive yield credentials currently, and we expect a performance advantage in future if and when interest rates continue to rise. We've designed the fund with 3 unique features that together give us a very unconstrained opportunity set, and it's that opportunity that gives us the chance to generate good capital gains. Those 3 features are the fact that we're global, we're investing across regions with no domestic bias. The second one is that we are investing across the capital stack, looking at both investment grade and high yield. On average, the fund will have a low volatility and be investment grade rated, but we will make use of those yield enhancing allocations into some high yield bonds. And third of all, we're multi-sector, so we're looking across corporates and mortgage-backed assets, again just to give us the flexibility to find the best opportunities on offer within this investment universe. Investors that are concerned about rising interest rates should definitely use this strategy as a way to navigate the rate hiking cycle that we find ourselves in. But also investors that are sitting on a large pool of cash or liquidity and need that cash to work harder can use this fund as a way to find some yield enhancement. We target a return of cash plus 150 basis points per annum on average over a cycle, so we can certainly make that cash work harder. And finally, for investors that are allocated heavily into high yield or perhaps bank loan strategies with full high yield risk, at this stage in the credit cycle, we could see some volatility in those strategies. Meanwhile, our fund is balanced across investment grade and high yield, so we can be more defensive if and when the credit cycle turns. For investors worried about the credit cycle and credit risk volatility, our fund offers a more balanced way to capture yield within the floating rate universe.